All right, everybody, welcome back to Cashflow Chronicles, July 10th, 2024. Make sure to hit the subscribe button. It is free. Apple, $232. Amazon, just under $200. Dutch Bros pulling back below $40. Google, $191. Palantir, which we'll get into a little bit later, just under $28.50. S&P 500 running above 5,600. Bitcoin has had a very fun run up and down. Below $58,000 right now. Oil holding flat since we last chatted on the 1st of July, $82. And natural gas, $2.50. Mr. Patel, it's been fun. I had a great July 4th weekend, and I got stuck with all the hurricanes and stuff like that. So I appreciate your patience. How are things?
Good, man. So I took somewhat of a short position on Palantir.
Yeah.
So you've been in it. You've seen it. Yeah. The thing is, I think this is honestly becoming the perfect trading stock rather than a long-term buy and hold.
It's always been that way, though. I feel like there's been times where it hasn't been, but I feel like it always kind of peaks and troughs.
Yeah, I mean, so here's my theory on that. There are so many people like from the retail side, and I think to some degree now with like the even the institutionals, that they feel like maybe they missed out on something, and maybe some of them are getting in right now. Because I mean, the volume that we're seeing right now is kind of up there. So I don't know. We'll see what happens. A lot of these people are probably going to be FOMOing in. Usually, I'm by nature a very contrarian person, so I see when the entire world is kind of like going in one direction, I tend to kind of like question it a little bit, and sometimes it's gotten me in trouble, and other times it's worked out really well. And most of the time it's worked out really well. So a lot of people are asking me, is like, what's your idea on shorting Palantir, especially with like the current like way the market is? And I'm like, well, it's funny because everyone seems to always like buy when people are fearful and sell when people are being greedy. And I see a ton of greed out there, but the minute you say I'm gonna sell because everyone's greedy, I was like, no, you're an idiot. What are you doing? You need to stay in it, long-term investing. And so I'm like, okay, sure, we can analyze that for sure, but
it doesn't justify 28.50. It just doesn't. And I'm 100% with you. I've been selling covered calls since like 25, 26. My thought process has always been, with the article that I need to rewrite now that we kind of have another earnings under our belt, but I think it was in February or March, I wrote that my price target for Palantir throughout the rest of the year is going to be $25. And I think that's where we're going to end up the year. And it'll cycle between 28 and 22, as we've kind of already seen. But I actually think in the article I wrote 20 to 30. But, unless something extravagant comes out of the earnings report in early August, I just don't foresee it being able to hold on to this valuation, unless it shows up with like a 30% growth year over year or something extravagant like that. I just don't see it being able to hold on to the premium that it has. And not to say that it's a bad company. I'm not saying I'm bearish for, say, the next 5 to 10 years. I'm extremely bullish for what the company has in store. But in terms of valuation, you do have to be somewhat realistic. And I just don't know, with the other competition that's going on right now, if Palantir has differentiated themselves from the other opportunities out on the market and how quickly they're growing. And I think the problem that is happening right now with Palantir, somebody that's a user and uses it pretty regularly, is it is a very complex product to use. It's extremely powerful, but you really have to sit, and it's not really something that you can just pull off the shelf that I feel like you can do with, say, Databricks or Snowflake, right? Which I think is a little bit easier from a user interface perspective. So I can understand where it might not be something that is used for the masses. Like somebody like yourself or myself, we don't have enough data that's streaming on a day-to-day basis to be using something like a Palantir. It just doesn't make sense. We don't have enough data points. We don't have enough touch points to really utilize it. Somebody like a Google, for example, though, which has so much YouTube data coming in on a second by second basis, could be somebody that is more useful for. But somebody like ourselves, so we might be more in line with being able to use like a Snowflake or a Databricks, because I feel like it's set up more for a smaller player. But anyway, that's just maybe my bias.
I also kind of have a bit of a theory on this too, that you know, there's this recent, I know I was talking to Sam, who's, you know, part of my Patreon about this. What we're seeing in the current market, and this is just a theory, it doesn't necessarily hold true. It's something anecdotal that I've been observing. But usually this is how you root out things, right? One of the things I noticed was the breadth of the market when it comes to corrections and recoveries seems to be really, really like magnified. So what you saw with this V-shaped recovery on Meta, it really threw me off, because like when it got down to like the 80s, I was shocked that the market was being so pessimistic on these guys. And it's the same thing on Netflix, same thing on Google, Amazon, and everything. So it kind of turns me into a situation like, okay, why are these companies that are obviously long-term, strong cash flow generating businesses, why are they being sold off so much? And I know some people are going to say, well, it's company related, but I think it's more than that. I think it's this growth of index investing has kind of thrown the price discovery mechanism completely out the door. So basically right now, if you look at like the S&P 500 market cap weighted versus equal weighted, dude, equal weighted is like flat.
Yeah.
Market cap weighted, it's like up and to the right, like crazy. So what I'm thinking is that since so many people are in this market weighted index, all this money that comes in from retirement funds, all this from individual investors, even institutional money right now is saying most hedge funds can't beat the S&P 500. Why am I keeping my money with this institutional manager who's charging 2 and 20 when I can just put it in the S&P 500 and make money? So I think the thing is, the S&P 500 is a great place to be if not everyone else is on there. Because if everyone else is in the S&P 500, there's probably some level of a bubble happening. So I think this is what's happening, where the better your company does in terms of like market cap, the more people keep getting piled on. And the more people pile on and buy shares, I mean, where these funds, these index funds buy these shares, what ends up happening now is that the stock price goes higher, which means now those same indexes or the ones that are tracking it are buying more shares of that company. And it's like this giant circle jerk that's happening. And it's funny because I think a lot of people right now, they're like, oh, the next catalyst is the S&P 500 inclusion. That means all these people are going to be buying in. And I'm like, doesn't that sound like a problem, that companies' valuations aren't based on fundamentals, but they're based on inclusion into an index? Like, that is it me that's just saying that? Am I crazy for saying that? You know,
I think everyone's just waiting for what happened with Tesla, right? I think that they're thinking back to when, you know, just to show people maybe on a 5-year rolling what you're talking about with respect to the S&P 500 regular versus the equal weighted, right? And the discrepancy that you're kind of seeing on a year-to-date basis, it being up about 5% versus the 20%, right? That's kind of what you're referring to here. And here's a 1-year view, and you can kind of see it splits even more. But going back to it, I think everyone sees what happened with Tesla, but you have to think Tesla joined when it was a top 10 market cap company. You know what I mean? Like, it was at the point when it joined, it was like 600 or 700 billion dollars at that point. So bigger than the likes of Visa, bigger than a lot of people. And you're right. I mean, it did need a lot of capital to kind of flow into it in that respect. But I think that that's what people anticipate, is that, you know, Palantir is going to enter at some massive sort of weighting into the S&P 500. You're going to have all this institutional capital going into it that wasn't there before, and thus it's going to fluff up the price. And I see some warrant to that. It'll help with respect to, I think, the volatility that we see in Palantir, where, you know, when their sell-offs happen, it happens really, really massively. But I think if it's more institutionally weighted, I think you'll see a little bit less volatility in the swings of that. But that also, you know, goes back to what you were saying, Kris. A lot of people have been playing Palantir because it has been a trader's dream. You do have these big 30% swings, even in the good times, right? There was no reason for it to dip back into the low 20s, but it did. And
the one thing I would just want to say, so Joe
Yeah.
Duane, whatever, is saying, I'm attacking the S&P 500. I'm not attacking the S&P 500 by no means by doing that. All I'm saying is,
where did you attack the S&P
no,
500? That statement.
yeah, exactly. I'm just saying the impacts of the S&P 500, the index feature, is becoming so normalized that now you're seeing more magnified recoveries and you're seeing more magnified drawdowns. That's the only thing I'm saying. I'm not saying that, hey, it's completely inaccurate or don't invest in the S&P 500. I think the S&P 500 is a great place to be long term, right? I think it covers most of the 500 best companies on the planet, and it basically the cream. What is it? The cream rises to the top. So no, I totally agree. The S&P is great. The only thing is the market weighted versus the equal weighted can throw things off a little bit, where the strongest companies get such a huge weighting that it ends up they end up magnifying the upside. But then also when things come down, it could also magnify things coming down as well at the company level. So my whole thing is, this isn't the S&P 500 is bad. It's just when you take things, when you take a step back, you're like, okay, you have to really think, like, why did Meta get sold off 80%? Just really dig down deep. It's like, how can a company this freaking powerful go down by so much? It's the same thing with Google. Now, I get it. Some of the operating metrics weren't exactly the best, but the point is the correction that happened shouldn't have been so violent to the downside. And I think even this rise that we're having right now, it shouldn't be so much to the upside either, especially among the giant mega cap companies. I mean, you look at now, I think $1 trillion company is literally 2010's billion-dollar company. You remember that back in 2010, you could never even imagine a company like, oh my God, $1 trillion.
When Apple hit $1 trillion for the first time, like, this is the fakest thing I've ever heard. And now it's done it 3 times, right? It's insane. It's literally insane.
Yep.
Interesting. So do you want to explain to people how you're actually shorting it? Because you're not actually shorting it, right? I mean, you're using an iron condor, which I don't know if you want to get into that because it is kind of more complex. And
I'd rather stay out of it, but I'll give people the finer details. If you want to take a look, you can. Basically, it is a play that if I am basically choosing a range that I think Palantir is going to stay in, right? My range is pretty, in my opinion, it's pretty wide. It's right now between $20 and 26 cents. Well, it's almost 27. So it's like 26.70. So if Palantir closes in between those two numbers by the end of 2024, which is 2025 January, because I actually bought out a little bit further out, I end up making a good amount of money. If I lose, I lose money. I lose my entire investment, but it's not going to be a lot. So, the risk to reward is actually in my favor. And especially when you consider that Palantir right now is trading at the top of its RSI, like in the 70 something right now, right? Valuations are absolutely crazy. Then you also have at the same time the Fed and all the stuff happening where the market is at a top. So some people are feeling that, hey, maybe there's going to be a correction coming. So right now there's such uber bullishness in the market that even a slight miss on something could drag the market down, right? Yeah. And this is typically what you've seen, where you've got all this bullishness and then 1 or 2 economic factors come in, and now all of a sudden there's a huge reset. And now that reset ends up impacting a lot of companies. Like here's an example. What if, let's say in the next 6 months, NVIDIA comes out and says, you know what, our guidance is not that strong going into 2025. I'm not saying it's going to happen. I'm just saying, what if it happens? Now, all of a sudden, all the companies that benefited from the AI wave, they're going to take a hit, right? Let's say inflation stays stickier and Powell has to come out and retry everything that he just said during the last 2 days and says, you know what? We're not going to have any rate cuts for 2024. Then what? Even how the market is going to react to the election, I don't know. It could react to the downside too. So a lot of these unknown factors, I think, are what I'm playing on when it comes to Palantir. I think Palantir is somewhat, and it's kind of curious because Palantir was one of the only SaaS players that was up today. Every other SaaS player was down. Palantir was up. I was like, shoot, what the hell is this bullshit? But whatever. I mean, this is how the market works, man. You got to do what you got to do, right?
Got to do what you got to do. I agree with you. I mean, talking specifically about the macroeconomics of the market, I was actually thinking yesterday, I'm with you, man. You were saying this the other day. I think it's honestly a bearish piece of sentiment when the market actually starts to get cut. And I think what that means and when why is because we've kind of been on this sort of piece here where it's just like data has been so good over the past, say, year and a half, which is why rates have been continuing to go up. And obviously now we've been flat, for a good amount of time, almost has it been a year? No, I'm trying to think. When was the last time we had a rate raise? Was it September of 2022? I'm trying to remember.
Yeah. Something like that.
No, September 2023. I mean, it's been a while. But anyway, I'm just kind of thinking it's like, you're starting to see some numbers come out of unemployment rising, inflation's being a little bit more sticky, but at the same time, it's kind of coming down in certain areas. So I'm with you. It's like if they do cut, it really is because they're starting to see these record high unemployment numbers and all these other things that we've been taking for granted with a strong economy. It means that it's really not as strong as it once was. And so, that's, I think the reason why the market has pushed so long into this is because the data has been so strong and we have been able to kind of like use it. But at the same time, it's like once you start breaking that cycle, generally speaking, and I think they related this to like 1994, 1995, when they were cutting rates back in 1994, 1995, I was watching on CNBC. They're like, by that point, you were cutting rates into a strengthening market. At this point, you're cutting rates into a decelerating market, a market that is not necessarily as strong. Had you been cutting, let's just say, over the past year at this point, then it would have been a different story. And I feel like you would have still had a somewhat similar result in the S&P, maybe a little bit, muted. But at the same time, I feel like now you've kind of, I don't know, it's going to signal weakness. And once you cut it, it's going to be like, well, why are we cutting, right? And 2% of a total cut over, say, the next 12 months, people are like, do we really need this? Is it actually that bad out there? Are things decelerating that much that we need this much of a cut? So I think it's going to almost have the reverse effect when we do cut, because people could be wondering why. And then you have the unfortunate impacts of, do you cut too much? And then inflation starts getting out of control again. So I'm kind of weary, if that makes sense. Everything that's kind of been done, it might be too late in this respect, and you're cutting into weakness rather than cutting into strength. And I think you're going to be cutting towards the end of a market, and unfortunately, it's going to exacerbate the situation.
One of the things that people keep highlighting is the money sitting on the sidelines, quote unquote, in money market funds, right? And that's absolutely true. There's about 6.5 billion, according to last quarter, of cash sitting in money market funds. Well, first of all, if you look at how much money market funds, usually there's about 3 trillion that's always in money market funds. And that's been pretty stable for quite some time, because a lot of people, they need liquidity, right? So in a lot of businesses, they need liquidity. So money market funds aren't like, oh my God, all 6 trillion have to get into the money market funds, right? The other thing is the money market funds right now, they're yielding close to 5.5% on that money. The long bond, which is the federal, the reserve, the Fed Reserve, like treasuries, they're yielding like 4 right now. So it makes more sense to be in money market than it is to be in the long bond. So the problem is when rates start getting cut, everyone thinks, oh, well, people just, all this money on the sidelines is gonna leave the sidelines. And instead, it's just gonna get pumped into the equity markets. And my thinking is maybe some of it will, but I think most of it is probably going to go into the long bond, where people are looking for yield and security, right? So I'm starting to see a lot of like institutional funds starting to kind of like move its way into that kind of like type of investment. So you're seeing a lot of credit starting to like loosen, where about 6 months ago you didn't see that, in anticipation of rate cuts. Because the one thing you want to do is you want to lock in a fixed return over a long period of time. Right now, if you can get a good amount of return just parking your money in a money market fund, you're not going to say, you know what, let me go buy a 20-year treasury, right? And the thing is, a lot of insurance companies, a lot of endowments, they need a certain level of return and they need it to be safe. So a lot of them are probably going to be parking their money somewhere in that, and they're not going to be buying an overvalued market. At least I don't think they're going to be buying an overvalued market. Of course, I could be wrong, and I think the money that does end up in the market might go towards more value stocks that have kind of underperformed the last couple of years, and basically have been pretty much debt-ridden companies. The other thing is it could also end up in corporate debt. So I think right now there's a huge corporate debt freeze that happens. So money is definitely going to be moving around and sloshing around, but to think that $6 trillion is going to end up in the equity markets. And by the way, if you look at the total value of the equity markets, 6 trillion wouldn't even make a pin drop on that of an impact at this point.
I mean, they make more of a pin drop, but I see what you're saying, right? It's small comparatively to the total market equities that are out there. Honestly, I think one of the safest investments you can have is investing in a 10-year, like an actual paper 10-year, because over the next 24 months, it's going to explode in value. Like because they're going to cut by 2%, and who knows, what does that mean? Is the yield going to go to low 3%? So you're going to go from mid 4% on the 10-year to a 3%. The value of that bond is going to the actual face value of that bond is going to skyrocket. And so I think that's almost like, because you think about it, it's so simple. I mean, you could correlate it to a T in the 80s to basically where we were up until pretty much 2021, 2022, when we started raising rates. Everything was always going down and to the right for yields. And so it's super easy to make money in bonds. And unfortunately, over the past 24 to 36 months, it's been a little bit tougher because we've been in an interest rate rising environment. But now we're going to get a little bit of taste of cutting again, hopefully. And who knows, maybe things get really bad in a recession aspect and they cut rates to zero again. Then your fucking bond is going to go through the goddamn roof. You could sell that thing for a mint. But honestly, I think that's the only guaranteed thing right now in the next 24 months is that a 10-year bond. In the short term, let's say the next 3 to 4 months, it might still be volatile and you might lose a little bit of principal on that on face value. But in the next 24 months, I think it's almost inevitable that would be a good investment.
Yeah, I mean, I'm looking at the market overall right now, and I'm seeing weakness in the market. And I know a lot of people are like, oh my God, this is great. This means that the Fed is going to cut, which means the markets are going to go higher. And I'm like, no, that means the economy is kind of souring a little bit, and usually this is not a good thing. I mean, historically, when unemployment rises, that's a bad thing for the economy. That means that there's less money in consumer pockets to go out and spend on things that you basically make money on. Because remember, everything is about goods and services, right? So it's the purchase of goods and services. So if you have rising unemployment, if you have a slowdown in growth, that means that future cash flows are kind of going to be challenged a little bit, right? So it's such a weird situation that we're in, that bad news is good news almost, and good news is bad news. So it's like, oh my God, the GDP just went up by 3%. Sell. The Fed is going to keep rates higher. And it's the opposite. Like, oh, GDP's come down to like 1%. Oh my God, we need to buy because now the Fed is going to cut. Like that's not normal, So it's such a weird situation, but we'll see what happens.
All right. Let's take an opportunity to look at the public portfolio. Once again, it's ranked based off of current value. So the positions on top have the highest value in the portfolio. Positions on the bottom have the lowest. So we're currently sitting about $2,700 total in portfolio value. Up a little bit today, 0.2%. And on the next slide, we'll show you how we're up year to date. Best things performing the portfolio, still TQQQ up 131% since October of last year. HIMS still up 50%. Verizon up 12%, so surprised it's hanging in at 41%. TMF is still hanging out, so talking about the 20-year in this case. Hopefully that goes up and to the right over the next couple months as we start to get some potential rate cuts. Rocket Lab actually turning around a good bit, $5.15 in the aftermarket. Snowflake turning around. The cruise line's hanging in there about 10 to 15%. That's where they were, I think, about a week ago as well. And then BPYPM hanging in there as well. So,
What's good is that we're also getting nice dividends from some of these players as well. So that's helping keep our total return for the year.
We're about to get one from Verizon here. You can see.
Yep.
So can't complain with that. Trying to think if there's anything in here. We haven't made any moves as of late. Hopefully by the end of July, once we get this channel monetized, we can start contributing to this again, because it's mostly just been on the growth of the portfolio. Any guesses as to how we fared over the first 10 days of the second half of the year?
Yeah, maybe just stayed flat, because I think we have some positions that might have underperformed. So I'd say we probably stayed flat.
So this is where we were July 1st. So we were at 40.5%, and you are right. As of yesterday, July 9th, we are at 40.3%. So flat. The market's gone up about 2% since then. So I think it was at 15.5. Yeah, 15.2 versus 17. So it's up 2.5% compared to our portfolio hanging in flat year to date. So
and we're still beating the index. That's what matters, right? Just keep beating that index.
Yeah, surprisingly, I think even considering we have some long plays in our portfolio, like Upsellera and Next and Rocket Lab, for example, all those are kind of dragging on the stock, or on the performance, right? And there's going to be years where, like, I think Rocket Lab, for example, over the next 12 months, that is going to have a huge benefit in tailwind once some of these numbers and actual news events start coming out and they actually get the rocket on the pad. But for now, it's just dead money, So Matt with the TQQQ. We have one share. I have about 1,300 in my personal portfolio, and it's done rather well.
1,300 shares of TQQ?
Yeah.
Oh, nice. All right, so you doubled up on that. Nice.
It's over a six-figure position at this point. It's going to be my future yacht fund if it continues to perform as it has. But of course, it's going to shit the bed as soon as the market turns over. So
we'll see. See, that's the thing with the leveraged funds, is that unfortunately you have to time with the leverage fund, because the return is magnified, but then also the drawdown is magnified, right? Yeah. So, but the good thing is historically TQQQ has gone up. So if you can theoretically ride the wave down and still be like, whatever, because you opened the position on TQQ before the drawdowns. So there you go. So you saw like an 80% drop. Yeah. And then you saw the recovery too. And you were still like, screw it, I'm going to hold on to it, right?
I was buying shares in 2021 when it was at 60, 65. And then I was buying all the way down when it was at 16, 17, 18 bucks in 2022. And I've been riding it up, and I'm not sharing my screen. Okay, good. So I'm up on my position total on TQQQ. Where the hell is it? Oh, I have it ranked by. I was like, where the hell is the volume? 70%. So nice. It's not as good, but it goes to show that, like, I started really buying it in mid 2021 when it was high, and I was able to follow through the cycle, and it's about where it was at the peak in 2021, 2022, and here I am up 65%. So if I don't know, I would recommend, if anybody's doing it and they can't handle volatility, then I would sell it here. But I'm somebody that's going to be holding this thing for 10, 20 years. So it'll be up, it'll be down.
What do you think my portfolio return is for this year so far?
85%.
About 100 and something percent.
Yeah.
Actually, I got very lucky with Celsius. That was definitely one of the biggest winners for me, because I was able to kind of time it in both the tops. So that helped out tremendously. But what really did it, believe it or not, was all the spreads I have on some of these great companies. So Google, Amazon, Apple, so a lot of those spreads are just absolutely printing right now. The only thing is, it's got to the point where a lot of my spreads are till 2026. So the thing is, now I've got the easy money done. The hard money comes now. So now I have to be patient and wait for it to basically go above my short leg. And then eventually I'll end up being able to like just theta decay away both legs and end up, taking a nice 500, 600% return on each of those spreads. Cause usually my spreads are about a 500 basis, 500% gain loss on there. So what's interesting though, and this is something that I'm gonna eventually have to like talk to like some of the people on Patreon on there, is don't split tens. If you guys ever played blackjack, everyone is looking at the market right now and saying, man,
can't lose.
Maybe I need to sell my current spread and instead go higher up in my spread. So basically, let's say you had a Google spread between 175 and 225 for 2026, and Google right now is trading at almost 200. They're like, oh my God, I'm already in the money. Now, I'm already up so much money. Let me just basically sell this spread and buy like a $225 and $250 spread for 2026. And the thing is, that would be the wrong thing to do. Why? Because the chances of it going even higher than it is right now is there, but it's not as good. So right now you would be basically like sacrificing a sure thing to basically be in something that you're not 100% guaranteed for. The reason why I was able to be so bullish on these companies is because the market had completely discounted these guys when the market fell off. And the thing is, they had huge tailwinds in AI that not a lot of people gave them credit for, that really right now the market is finally starting to wake up. So a lot of people are asking, is there a lot of upside left on the Mag 7 companies? I'm like, yes, there is, but not as much juice as there was when you had Google in the 120s and 130s or Amazon in the 150s. Like the price has gone up substantially. So do I think that they get to above my strikes by 2026? Absolutely. But I think the move higher from here is going to be a much more trudge than what it was about 6 months to a year ago.
It was much easier money. No, I think that's really easy to say. Here's a 1-year chart on Google. And, I've been long since the end of 2022. Really buying pretty heavy in the 80s, and not to humble brag, just to kind of state, I had shares before then as well, but I was buying all throughout 2022, and I have not been buying Google because it's just been such a price discrepancy. I sold some puts, I think like 120 or 125 puts in this March 2024 range, was never assigned them, made a little bit of money, but I think my price target by this time, I think in March, April, when I wrote my Google Seeking Alpha article, was 185-ish by the end of the year. And here we are, it's at 190. And I think you were comparable. I think you were saying it was going to be 190 or so by the end of the year. So I think we had a very comparable target. Mine was just based off the strength of cloud and how it's going to perform. And I think that's going to show. But honestly, I think if you see any, like you stated, there's a lot more downside at this point than there is upside. I mean, just based off of what we're seeing here, price to earnings, and I know Robinhood wasn't always the best. You're at a pretty much 29 price to earnings, which is pretty rich for Google generally. Generally, Google hangs out between the 22 to 25 range. 25 is generally when it's pretty much fully valued. So unless you continue to see growth in Google, an acceleration of growth, I should say, to warrant the higher 28 times price to earnings, I feel like if there's any hiccups, you're going to see a 5 to 10% pullback very easily. So this thing could go back to 160, 170 very easily. And I'd say the same with Amazon. Amazon's hovering at 200. I could see that pulling back 10 to 15% as well. And that's not to say that it's going to stay there. It's just a quick reset. And I think it's just because the multiples have expanded that much. It just doesn't warrant it to be up this high.
And also remember, sometimes you have to let the PE, the forward PE, catch up to the existing PE, right? So Google right now is still growing its top line and it's doing share buybacks. So if you think about it, 225 for 2026 for Google makes sense. Above that, I'm not so sure makes a lot of sense. So like I said, a lot of what I did is a lot of the homework that I did with a lot of these companies, ended up figuring out, okay, what is the absolute max that this company could possibly be in 2026, and then basing a lot of those spreads based on that. And it looks like I'm going to be pretty much hitting my target within a 10-20% discrepancy up or down, right? Which in the spreads world is great because you have this huge ability to get this return. So, you know.
Yeah. Speaking of buybacks, do you want to hop into Airbnb?
Yeah. So one thing I just want to say, June is like, I'd rather just buy and hold good companies. Absolutely. Most people should just buy and hold good companies, and just hold the stock. The problem is the stock and the options are two different things, right? When it comes to the options market, you have to remember that it's all time based. So as you get closer to the time, you're going to lose value on that options contract. So even if the company is great, you can get completely wiped out because you're in a time limited asset class. So just keep that in mind. Like, you can be in a great company, but you got to make sure that you have enough time. And believe it or not, I'm probably going to sell out of my spreads way before expiration, even if that means that I don't maximize my gain. Why? Because the last thing I want to do is go into, like, let's say a November and have a black swan event hit you, and now you lose your entire position with no chance of recovery.
Bird in the hand.
Yes,
Gotta take it.
yeah, you gotta make sure you're taking profit, especially when you're up so much. And a lot of this is just, really good risk management. So
yeah,
it is.
I do the same with my covered calls, man. If I'm up 60-70%, and there's only 25 or 30% left to squeeze, and I have a couple weeks left, what's the point? Because the stock could easily go the other direction and you lose all that. And then so it goes in the money. So it's like, what do? You buy it back. Yeah, you only made 60 to 70% of that premium, but the stock ends up going the other way. 2 to 3 weeks later, it's at another small little peak. It gets fully valued again. And you're like, okay, then you sell another, right? As opposed to having to wait for another 2 to 3 weeks to get the other 20 to 30%. It just doesn't make sense, right? You sell the options when they're high, you buy them back when they're low with respect to covered calls. It's super easy. The stock's up 2 to 3% that day, sell the call. If it's down a couple percent and you're getting the opportunity to buy it back at 40-50% the next day or 2 days after you write it, sometimes it's best to just buy it, buy it back. So in your situation as well, if you're up, the majority of your value already, you have a bird in the hand. Look what happened with Celsius, right? People were getting greedy with Celsius, and they're like, okay, well, do I just hold until 2026? It's like, no, like, you have the pretty much maximum value you have right now. Like, yeah, you might lose out on some if you don't hold, but who's the guarantee that the stock is going to hold above $100 a share? And we saw what happened with Celsius. It's pulled back pretty drastically. So
yeah, that's the other thing too. You always have to be scanning the market when it comes to options. If you have an options play, you have to stay in tune with your position. You can't just buy an options play and then leave it alone and be like, oh yeah, you know what, I can just go do my own thing and everything will be okay. It's like, no, you better keep your goddamn eye on that thing because it might not work out for you.
Might not, man. So this is another one that Kris brought it up today. I did some research and I was actually kind of confused. I initially looked at it, I would say after the 1Q earnings call, and I wasn't that impressed. But now looking back, this is one of the things that I want to let you guys know. I made a mistake. I thought this was rather fully valued. And to be honest, I think it's fairly, if not slightly overvalued, but it's not expensive like I was thinking after the 1Q earnings call. And so we can get into a little bit why. I want to let you guys know my mistake. Sometimes you read things and you read them too quick and you think that you're smarter than you really are. And sometimes you really have to soak and reread things again. So this is my second time reading through the numbers. Kris said, hey, let's look at Airbnb. We have about 20 minutes left in the show. We can talk a little bit through it. But I looked at the numbers again and I'm like, oh, it's not nearly as expensive as I once thought. And it goes to show you that sometimes you need to take a once or a second look at something that, with fresh eyes, and you might come to a different conclusion than when you did before. But Kris, why did you want to bring up Airbnb today?
Well, so Airbnb's always been on the brain, but it's, usually in a negative light. Like I still have a somewhat moral stance against short-term rentals. as a form of income generation, because I think that sometimes they can get out of hand, in which case now like entire communities can get replaced by short-term rentals with just people looking for a short, for a return. But I think it's, the market is changing a little bit, and I'm starting to realize that the quality of housing tends to also improve in certain areas because of the opportunities that Airbnb gives, right? So there's economies and there's people who have jobs because of this industry. So I can't fault it. The other thing is it's also helping improve the hotel and motel industry, because before you had a consumer base that you could treat however you wanted and people just, they didn't have a choice. They had to stay with you. Airbnb kind of, forces them to kind of improve a little bit. So in terms of for the consumer, it ends up being good. I do like that certain counties and certain cities in the United States, and I think even some countries, are starting to just be like, hey, let's actually regulate this. Because I think every industry needs some level of regulation where you basically take the huge speculators out and you leave people who actually can develop a good business around it. So one of the things that I've noticed is like Airbnb, some of the complaints that I've seen on Airbnbs is, some of these people are basically like, the quality of people's stays have often been really subpar, because it's like, you have to do the laundry, you have to do the dishes, you have to do this, you have to do that. And it's gotten to the point where people are getting a little bit fed up with Airbnbs. But then I also had to take a step back and look at the business model. And the business model actually is very elastic. And that's really a great thing, because Airbnb itself, the main company, is not really taking on any major risk itself by having to buy properties, renovate them, do all this stuff around it. It's just providing a service. But what's more interesting is in terms of like a long-tailed business, they're pivoting in all the right directions. Now, the first thing I want to just give a shout out to is Sam Mercier. Okay. I did not really look into Airbnb, but he reached out to me this morning and said, Kris, have you been checking out Airbnb? I said, no, I really haven't. Let me take a look. And he went over the numbers with me, and the numbers are very compelling, Matt. And the reason why I asked you to be on here, especially, and have this discussion, is because your family has multiple Airbnbs that you guys run, right? So the unit economics are something that you can actually pretty much figure out, and then go based on that to say, okay, where are we likely to go with this industry, and how much of a market share does Airbnb have, and how are they essentially going to do in the future? So Airbnb only recently, in terms of like public listing, only recently publicly listed. I think they are literally like the number one in terms of short-term rentals in that category. There are competitors out there like Verbo and there's quite a few actually, but these guys have really like done the excellent work required to basically build out this entire network of people and renters, and also Airbnb hosts. And I think overall it's a pretty strong business that has a lot of upside. So.
Yeah, it's interesting. I mean, I can talk about it from. I've had one rental since 2022 that's pretty much up and running, and we just did one, and we bought another house in May, and have that up and running now. It's about 10 out of the 11 main weeks for the summer are booked out. So somebody canceled on us in late August. So hopefully we can find somebody. So if you're looking for South Jersey beach rental, let me know. But it is interesting, and it goes back to what you said, Kris. I think this is something that people tend to forget, is I employ people. And I think people don't really understand that. It's like I employ because I'm out of state. Obviously, my properties are in South Jersey. The people that I invest with, my sister and my one of my best friends, they both live in, across the river in, I guess west of Philadelphia, probably like 40 minutes outside of Philadelphia. So they're not driving 2.5 hours down to go cut the lawn or clean the house when it needs to be turned over. So we're fortunate enough that we can find people locally, and they're ecstatic. They have people, they live for the summertime down there because that's their bread and butter to make money. We employ both places have hot tubs. One has a pool. And so we employ people locally to do the pool maintenance. So that's a couple $1,000s a year. So if you think about it, that money gets flooded back into the economy locally as well. So it's a plus and a minus. I would say, based off what you stated, I do agree. In 2020 and 2021, there was so much money being spent on Airbnb because everyone was so able to be mobile. I think at some points the lockdowns were just too much and people were kind of just working from wherever the hell they wanted. And so they pretty much could rent an Airbnb for, whatever price that they wanted because money was so flowing at that point. They could get away with anything they wanted. You've started to see a lot of people get rid of Airbnbs or really step up their game. So you can't really just have like a bed on a mattress on the floor anymore. People aren't going to be tolerant of that. They're actually going to look for, and there's so much choice now that people are not really going to put up with it, right? And now they will be willing to write you a crap review. But yeah, I think it's an interesting case from somebody that actually sees both sides of it from an investment perspective from the stock, which we can get into in a second, and also the use of the platform itself. I would say it's more superior than VRBO by a long shot. The ability from a automation perspective as well as just a user interface perspective, managing two properties through Airbnb is much easier than on VRBO. VRBO, I just don't understand how they make it so complicated. It doesn't need to be. Just take a book, or take a chapter from Airbnb's book and just make it a little bit more, make it a little simpler, like Airbnb does, and you'll be okay. But I just don't understand why VRBO. But at the same time, we have higher quality tenants generally from VRBO. So I don't know really what the answer is, but. More to come on that space from and I'll get off the soapbox about how I'm a host on Airbnb and VRBO now. But yeah, if you guys have any questions on that, we can get into it. But I'm more curious about the financials at this point because it is really intriguing how this works. I think this is like a pretty unique business on how in really seeing how cash flow comes through a company in terms of working capital and actually being able to realize revenue at certain times and how that fluctuates with net income and the seasonality. It's actually really cool to be able to see. So, and I missed it the first time I walked through it. So going back to how I made a mistake, I didn't realize the seasonality piece and how the cash flow aspect works and how you realize revenue from quarter to quarter with this business. And it's really cool when you look at it on a cash flow statement.
Sam got someone's like, is Arnie big on Airbnb? Arnie is big on Airbnb, and what's his name? Sam probably got him to convert also. So sometimes one of the things, and Matt, I'm sure that you know this, having people around you like good investors is probably one of the biggest alphas that you can have, right? Where if you have like a community of people that you respect, that you value, and that they can actually, they know what they're talking about, dude, it is awesome. Because now what happens is you can gut check yourself 5 times against other people that are good investors also. So imagine right now, instead of trying to just figure out one thing by yourself, you've got 5 people that you can kind of throw your idea at and see hey, is my idea worth pursuing? And if you get 5 rejections, you probably know that you're wrong. If you get 4, you're probably wrong too. 3, 2, and if only one person rejects it, you're like, hey, wait a second, the thesis may be actually pretty good, know. And I think that one person's just being contrarian. So when you have a consensus driven kind of situation, a committee based investing approach, you can actually do pretty well, especially if you get some really smart people on that committee. So I've started to develop sort of a internal resource community where I get some people who are subject matter experts on one industry, other people who are really good at another, and then kind of just combine that together and see if everything works out. And sometimes, you know what, I'll completely disagree with all fucking 4 of them, and I'll be like, oh, fuck you, I disagree with all of you.
Hey man, not a lot of people agree with me on Rocket Lab, but it's a different type of investment. So.
Yeah. So one of the things that you can see here, one of the things that I would highly recommend is when it comes to businesses like Airbnb and travel and leisure or anything, seasonality has a really big impact. So you can see growth kind of go up and down, up and down. So the best thing to do is just go it based on a trailing trailing revenue number, because this way you can actually see like, hey, is it trending up or is it trending down? So one of the things I like is that revenue growth is starting to kind of like level off, right? Usually when a lot of these companies, they come public, they usually have a tremendous amount of revenue growth at the time, so that this way they can highlight it like crazy during their road shows. Like, oh, look, we're growing 100% year over year. So this way their valuations are at the peak and all the insiders can exit at a pretty high multiple. One of the good things is that once they get past that few years, that early years of that IPO, they actually start to show like more tangible run rates. And also the law of big numbers tends to always come in also. But you can see here Airbnb's revenue growth has kind of like gone down, but it's kind of like leveling off now. And the thing is, it's almost a 17 to 20% growth rate on revenue. That's excellent. That is a really good number to have, especially if you can sustain that over a long period of time. But what's also interesting is in terms of operating income, they're also getting back to somewhat of a normal figure, right? They've had some one-time expenses that they had to recognize, which is keeping their operating income somewhat muted this last couple of quarters. But if you look at it from a cash flow perspective, look at this operating income up and to the right, right? On top of that, when you look at the shares, they're buying back shares. They're using half of their cash flow to buy back shares right now, almost $2 billion. So if they're generating $4 billion, they're taking out $2 billion in cash flow. Now, their share count hasn't necessarily been that great, but you can see here now that the shares are starting to actually come down now. So their share count is starting to decrease. So that's boosting up their EPS, which means the valuation is eventually going to catch up. So right now, they're generating about $7.52 on a diluted basis per share, which is, in my opinion, amazing if you think about the current valuation and its current growth rate. So I would not do options on this, but I definitely think this is a candidate for just buy it and hold it. Their EBITDA margin is kind of flattened out as well. It's kind of just chilling right now, which is fine with me. But as long as their revenue growth, 20% year over year, you can kind of see where this business is headed over a long period of time. So if you go to like, let's say 2028, there's about 6 analysts who believe this thing is going to have about almost 18 billion in revenue. And I could see it getting there, even with a slowdown in revenue. Their EPS is going to be growing about 13, 16%. So the ROIC is pretty damn good.
And in the cash flow margin, going back to that, has been about, it was 20% several years ago. It was 30% last year, and it just ended 2023 with about high 30s, low 40s cash flow margin. So if you're taking that 17, 18 billion, that means you're going to be close to, I don't know, I'm not good with math, Kris, but $6 or $7 billion in terms of free cash to the business. Maybe even closer to 8 billion in terms of free cash to the business. So if that's the case, I mean, multiply that out by 20, you're talking about, in 3 to 4 years of 40 to 50, maybe even a 60% growth in the share price. I mean, it's not a slam dunk per se, but it's definitely not super expensive like it is today. The trailing 12-month free cash for this business is over like $4 billion. It's pretty impressive. And what's confusing to me was how, like you stated, in the current quarter, it shows up as a net income of only like, I don't remember what it was. It was like $250 million or something like that. But the reason being is because they take so much capital in the first quarter for second quarter and third quarter vacations that it's, generally speaking, a very cash flow income heavy. As you could hear, they're probably on pace to make $4.5 billion in free cash this year. They're taking like almost half of that in the first quarter for vacations in the second and third quarter. And then they'll be able to realize that income in the second and third quarter, because that's just how mark-to-market accounting works. So people are giving them cash early. They're able to get interest on that cash because it's literally sitting in a bank account, because they're obviously taking deposits and they're not paying it out to hosts like myself until somebody checks in after 48 hours. Then they release the funds to somebody. So if I had somebody check in on Sunday, I'm just getting paid today. So if they booked that last year in the summertime, they've been holding on to that capital for literally 9 months at this point, waiting for it. And I have I have literally this summer on Airbnb and VRBO probably close to $50,000 worth of capital just waiting at Airbnb to be paid out to us. So if you think about it, they're just sitting on that, collecting that 5% yield until they pay it out to us. And then they realize that the second and third quarter. So that's when Kris is talking about that lumpiness, that trailing 12 months, it smooths that out. And I think it's what you really need to look at is just year-over-year growth. Is the first quarter year-over-year growing? Is the third quarter year-over-year growing? And that's what really matters, not the sequential quarters. You really need that year-over-year. And to me, it was pretty impressive to see the share buybacks. I think if you continue to see this, Kris, I don't really know what other capital expenditure they would put into the business other than throwing off dividends and buying back stock. And so to me, it's almost like, is this a future AutoZone play where they're just buying back like a couple billion, $2 to $3 billion worth of stock a year? And I think at the company right now is about 100 billion, if I'm correct, in terms of market cap. So
like
that'll be about, that'll be 2 to 3% of, and I think they have a $2.5 billion buyback authorization right now. So if they are able to maintain that $2 to $3 billion a year, you're buying back 2 to 3% of the float, then you're growing EPS by probably 10 or so percent. I mean, you're looking at, an EPS growth on an annual basis between 10 and 15%, maybe even the high teens for the next couple of years. That's pretty promising. I think the only thing that you could be scared of is if there truly is some sort of recession and people really want to hold on to their money and they stop traveling. But we're in a business right now that numbers in terms of travel are up more than they were before the pandemic. Amit talked about this on one of his live streams earlier, but I saw it handily this past weekend traveling. I've never seen the airports more busy than this past weekend. And, we're talking about 3 million people a day that are traveling. It's insane. So anyway.
Yeah, and they're all going to need to stay somewhere. They're all going to need to basically, go places. The other thing is like Airbnb now is branching out into like so many other like things that are unique experiences, right? Like one of my friends, this is like about 4 years ago, he calls me up and he's like, I need $100,000. I was like, what's up, man? Like, I like you, but 100 grand, I don't like you that much, right? And his idea was that he was gonna basically go out into the New Mexico desert and buy up this like RV community and just like redo everything and just turn it into like Airbnbs. And the thing is, like, it had like really great views. So his thing was, I could just probably turn this into like a giant Airbnb thing. And I'm not so sure what happened to him, to be honest, but I'm pretty sure he did well because I saw him on Instagram a few times, and he's probably doing really well off of that. So I also, like, me and my wife, we also stayed at this one experience that we had near the Grand Canyon, where it was just like a tent city in the middle of like, I forgot what state. I think it was Arizona, but it was awesome, dude. It was just, we stayed in a bunch of tents, and the thing couldn't have cost maybe like more than like $5,000-$6,000. Well, probably more actually, because it was like a glamping tent based like with a platform and running water. I forgot what it was called. Maybe my wife can tell me what it was called. Let me see. Hold on one second if I can find it. But they have like a bunch of places around now. Something under the stars. Hold on. Glamping. So it's basically like this. They had just a bunch of these canvas tents. Damn it! I really want to under the canvas.
The yurt tents, whatever the hell they are.
Yes. Okay, I found it. I think I found it. So let me show you. Okay. So this right here, like Grand Canyon, right? So they have like places like this. These are just canvas tents, but they're staffed really good. And this is what it basically looks like. Let me just bring it up on the main screen. Hold on. Let me share this one.
That's where the big money gets made. That's where the cash flow gets made, I should say. And also, if you think about it, because they probably spent so little, they had a lot of forethought. They made something out of nothing. They literally changed the value of what that land is worth based off of putting that business there. And that's where you really make a lot of money in the Airbnb and hospitality business, is literally creating something out of nothing.
Yeah, let me blow this up and check it out. cut the sound because I don't want to get demonetized. Well, you know what? We're not monetized. You know,
You're rich, my guy.
it was okay.
Yeah, it looks pretty plain.
Yeah.
It's legit just a yurt tent, dude.
Mm-hmm.
And you can get that for like $2,000 on Amazon.
I know, right? And so they built out, like, this is the entire thing that they built out. And it's pretty close to the Grand Canyon. So.
That's awesome.
And so, you know, just to cut it a little short, but they also had like value added services that were on top of there. So it's not just you stay at a tent. It's, hey, there's actually like activities and stuff that are there. Then there's like food that you can go and you could buy, like, you know, because if you're going to stay somewhere, you're going to have coffee and tea, which has 80, 90% margins, even 400% margins. But the thing is, people are going to be there, right? So I'm telling you, people really have to go and try. Did I do yoga? No, I didn't do yoga. Me and the wife are not. I'm not yoga material, dude. No. But it was really good. We had a great time. It was very close to the Grand Canyon too. So like it was a great place to stay overnight. Just for like a very short period of time. You know, we got an experience. It was like it felt like you were camping, but you didn't have to do all the camping related work. You know, and I think one of these days, maybe like, because they have multiple sites. I think they have one in like Moab, another one in Bryce Canyon.
Moab's a great fucking place, dude. I like Moab a lot. Yeah,
I haven't been.
Well, if you're into hiking, Arches National Park is really cool. So that's where like you see all like the big arches and like the big orange rocks and stuff like that. But I've never seen a place so beautiful with the stars at night. And then also Moab's a cool little town. Utah, obviously, not a lot for drinking, but if you like small breweries, they'll sell non-locals. If you bring in your non-Utah ID, they'll give you like the full strength beer. But if you're like a local Utah, they'll give you like the baby strength beer. So it's pretty interesting. But Moab was really cool. But I actually thought about doing something similar in Terralingua in West Texas. And reason being is more so for me to just like get the hell out of Dodge. But you can buy like 40 or 50 acres of literally nothing, kind of like that, for, you know, not a lot of money. And so you put the first one there, you get it up on Airbnb, you get a little cash flow going. You know, I'm not going to be there 24/7. If I find a local to clean it out, it would be for me to travel like 8 hours and like, you know, once every couple months, like get out of Dodge and just like get out of the city and reset my mind and stuff like that. But yeah, if you think about it, you could split it up and eventually, like you stated and showed in that video, you know, get a little convenience store in the middle of all of them and, you know, things like that. Next thing you know, you're employing people and it's running itself. And the cash flow with something like that, creating it from the ground up is huge. And one of the big ones I've seen in Texas even is if you find a property that has a well on it, like a naturally occurring spring, you could set it up so that you can create kind of like a miniature lake on your property. And I've seen a lot of people do really well with that, putting like little like man-made lake and having like 5 or 10 A-frames around it, and then coupling it with like an actual pool and, you know, other comparable sort of amenities that you showed in that place. And I've seen a guy turn literally like $100,000 property into like cash flowing. I think it was like $500,000 a year. And I think he sold it for like $8 or $9 million. And there was just 5 or 6 little A-frames, and it wasn't anything huge, but because of the presence and the experience of it, he was selling it for like $500 or $600 a night. And it was just like a 2-person A-frame. So,
oh, by the way, that thing was not cheap. That thing was expensive.
Yeah, I bet.
But here's the thing. It was completely packed out because the experience was so good. It was very unique. Like you couldn't just find these things. So Airbnb, I think, has such a great potential for people. Like, bro, we need to fucking find some places, Matt. We need to find some exotic locales with some cheap freaking land. And we need to build something like this where we can sell experiences to people, you know? Cashflow Chronicles aside, man.
How far are you from like a lot of local trails and stuff like that in Georgia? I'm sure there's a lot of trails that are around there.
I'm kind of in the suburbs a little bit, but not like
Okay.
suburbs. So I'm like, how do I say it? Like it's like the outskirts of the suburbs, basically. If you were to go further up from me, that's when you would see like the cabin area. Like some people have
Mhm.
like entire cabin retreats where they have a
Yeah.
bunch of cabins. So yeah, I mean, like the way that Georgia is that if you go like way up to the north, like close to the Appalachian Mountains, you're gonna have like the Blue Ridge Mountains. They're amazing. The only thing is, a lot of people got into the Airbnb scene up there. So if you look at the value of those cabins, if you look about 4 or 5 years ago, there were maybe like a couple of 100,000. Now each one
No,
goes like
500-600.
500,000.
Yeah.
So
Are you
it's
talking
gone
like
up.
at the trail end of like the Appalachian Trail and stuff like that? Is that what you're kind of talking about? Yeah.
Yep.
Yeah.
Yeah.
Yeah. My one buddy, when he went, I was just like, this is a smart idea. I started looking at trails around the US, like popular trails, because there's the Appalachian Trail, which a lot of people do, but then there's a trail on like the West Coast or something like that people also do. And I was like, I was like, if you find steady areas that people often like step off at and take like a couple days rest. So it was like, that probably would be a pretty good place as well. And to be honest, if you want to get into real estate talk, there's a lot of good things that you can do with real estate that, halfway houses is one but then you have to deal with the headache of being a halfway house. Right. But I saw that with my brother. He was in a couple halfway houses and you're paying $500 a month for a mattress and you sleep like 3 or 4 guys in a room. It's like $2,000 for this like room and a single, like you start thinking about it. You're like, Jesus. The next thing you know, it's like a 4 or 5 bedroom house. And then it's got a basement and there you have like 5 people in the basement. It's like, Jesus Christ, how much money is this house making? So anyway,
this reminds me of like, there's this place in Brooklyn where, the Hasidic Jews, they live like near my old high school. Dude, they buy a house, but there's like maybe 10 people that are living there, and so that's how they like afford, like their houses are really nice. So like back in the day, you'd be like, man, how are they affording to live here? It's like $2 million, and this is like 10 years ago. So but the thing is, there's so many people living there that they all share costs. And that's the thing with a lot of immigrants too, like that are coming from like Venezuela and Honduras and stuff. They're coming, but they all live together in a small apartment and they save a ton of money that way. And then eventually they buy a big house and then they all live together, So it's a very interesting like dynamic that's out there. So
cool. Well, you're the man. Yeah. If you have any ideas, I have some capital. I like it, man. You just have to find some local people.
I want to, believe it or not, my IRA is gone 7 figures now. So I want to do it in my fucking IRA, and I want to go Peter Thiel. I want to go Peter Thiel IRA status, man.
Can you imagine?
Where,
Jesus Christ.
Dude, that means I have no taxes on any of my gains. Like, I don't care. I would do it, and I already looked up how to do it too, like using a check, like an LLC, and then do a self-directed LLC. I'm like, but the thing is, it's my IRA, so I don't want to take too much of a risk in it. But at the same time, I'm like, man, you know what? I'm still young. I could, even if I lost it completely, I could do it again. So I'm at a point right now. I'm like, man, maybe I should start a business in my IRA because I do have the liquidity enough to do it, and yeah, dude, that would be so good to just Peter Thiel this bitch and then one day sell it for like $20 million and have a $20 million tax-free IRA.
Yeah.
Oh God.
That's the thing, man. I think a lot of people, I mean, just the last piece, I guess, sorry to keep dragging it on, but if you like you can get to a place where you have $10 million or so by investing, but it's going to be fucking tough. The real money is going to be made if you're doing like sweat equity in something, building a business, having other people work for you, leveraging their time, because you can get them to add value and then you're paying them, say $15 an hour, but they're managing your hotel. And that allows you to go and focus on X, Y, and Z and find that it's like, you think that you're a scumbag because you're, a landlord or something. It's like, this person needs a job at the end of the day. Like you're employing them. And I think that that's something that's kind of undervalued in today's society. I think most people look at like people that own Airbnbs or trying to make it as real estate investors are like scumbags for trying to like make a living or like try to better themselves or better their family. But at the end of the day, it's like there's 4 or 5 different people that I help employ through just my business alone. And it's pretty cool.
How much are you getting close to the 7-figure mark in your retirement accounts, or no? Not yet.
No, I don't actually put a lot in my retirement accounts. A lot of it's accessible because I just want to make sure there's no restrictions.
You have liquidity?
So I have liquidity. Yeah. So like if I ever, eventually I want to get into home construction. I think I told you that. And so I don't want to like have to deal with the complications of an IRA. Yeah. And I also want to put leverage, right? If you have an IRA, you can't lever things.
Yeah,
you have to put cash.
Yep.
So that's part of the problem with doing something in a retirement account. So my large individual brokerage account, that's over 7 figures, but all collectively, I mean, definitely over that. I'm trying to chase the next M at this point. So it's actually kind of fun. Like you start multiplying things a couple times. It's like Patrick Bet David always talks about, you're 2 doubles away from whatever. It's like you get 3 doubles for me, and you're like, that's my goal.
Yeah.
3 more
for
doubles.
For me, it's going to be to retire early, but I have a mechanism. So the way that I'm going to do it to be very tax efficient is basically take my traditional IRA, so the way that my traditional IRA became so big is, number one, I started very early. I started like maxing out my 401k contributions very early, and I've always done that every single year. And I've done good in terms of investing the money in there. But what's more important is that it's been a consistent grower over a long period of time. And so that compounding effect has really helped out a lot. Now, the problem is access to that liquidity is almost gone for me. So I don't have access to any of that money until I turn 59 and a half without paying a penalty. But there is a secret way, not a secret, but there's a way that you can kind of leverage it. So the way that you do it, Matt, is, let's say I want to retire, right? I have money on the side, so I can use that money to basically live off of. What I would do every year is take excess amounts from that traditional and convert it into a Roth. Okay. Now, the thing is, you would pay taxes on that. You would pay taxes on the amount that you convert. But the thing is, you do it slowly over a period of time. The benefit is that anything that's in the Roth grows tax-free. So now if I just take, like, let's say $100,000 or $200,000 from my traditional, I'll pay taxes on that, right? But the compounding effects of $200,000 every year getting put in grows like crazy. So by the time I am in my 60s, my Roth will be freaking stacked, So it's a very interesting way to.
Do you not you don't do the backdoor IRA?
No, not right. No, because my IRA right now, there's 2 problems that I have.
Yeah.
Number one, I make too much money. So there is a way that I could backdoor it, right?
Yeah.
But at this point, I've already maxed out so much, it doesn't make too much of a sense to keep doing it, because I have to keep flipping back and forth. So it's not worth it. The other thing is,
sorry, I'll let you finish. I'll let you finish first.
Yeah, no. The other thing is, like, most of the money that's in the IRA actually came because when I left my company, I moved my company's 401k into my IRA, right? My traditional IRA. So you can move a pre-tax 401k into a pre-tax IRA. The benefit to moving that way is because now you do have control over the investment decisions that are not going to be limited by that 401k that you had before. So that's been a pretty good thing for me right there. And then after that, you can move that into a Roth, but like I said, you have to pay taxes on it. But the good thing is, if you don't have income that year, you don't necessarily have to do that. You could just put it into, you're basically at zero, which means any money that you withdraw, you're putting in there. So basically you're living off of the money that you have already. So you're not paying any taxes, but that's because you don't have any income, So there's another thing that you can also do. And this is the one that's like, I'm sure you heard of it before, but it's called, what is it? Borrow. God damn it. What is it called? Borrow something and then die. Basically what you do is, you take money, you put it into a a separate account that allows you to basically borrow against the value of your collateral, and you live off of that. And basically now, if, like, let's say you have $1 million, you put it into that account, you get something called an SB lock, right? The SB lock, now you get cash, you get liquidity. And now you have to pay interest, but the interest that you're paying is basically coming from that thing. Now, the thing is, as long as you're only withdrawing you're not withdrawing, technically, you're borrowing a set amount. What ends up happening is the growth in that portfolio could theoretically outpace your actual money that you're spending. And so a lot of people, that's like, how they say the rich do that? That's what the rich do. So if you have, let's say, $1 billion in securities and stock, you can just pledge those stock and get a loan, and you would use that loan to live your life. But the thing is, remember, that's a loan, that's not income. So you're not paying any taxes on that income, right? Yeah. Now, the funny thing is, when you die, your cost basis on all the stock that you've owned since the very beginning end up getting reset to whatever the amount is when you die. So when you pass it on to your kids, if you bought Apple at $1, now it's $100. For them, it's not like, oh, they have to pay a taxes on $99 of gains. They only pay a tax on that $100 now. So the thing is reset. I forgot what the damn term is. I can't believe
step up in cost basis, or
step up. No. It's this freaking term, man. It's essentially how the rich get away from not having to really pay taxes. They just borrow money using the stock that they have, and then they just pay that money. And the thing is, it's never to pay back the debt. You don't ever pay back the debt. You keep the debt going.
Yeah.
So,
but yeah, to give you an idea, if you remove stock-based compensation that I have, 27% of my money is in retirement accounts. And then I guess if you include that stock-based compensation, it's like 32%.
Someone got it. Buy, borrow, and die. That's 2 a.m. That's it. Yeah. Have you heard of that before? No.
I've heard of people doing the life insurance piece. And basically just like always keeping life insurance alive within, and if somebody dies, and it just continues to grow. And that's kind of what some really rich families have done in the past. But
come on, man, you getting there now. You're getting to the point where you're secure. Now you got to figure out how to leverage your portfolio to make more bets, right?
That's the thing. It's like I'm trying to get to a place where the more I realize how money is actually created in the world, the more I'm like, you can take on more risk, and it's not going to be that big of a deal. But as long as I've seen people take on absurd risk. Yeah. And that's the thing, is it's like, I don't want to get to that place, right? If I were to do anything, you gotta walk before you run. And every time I see somebody get absolutely fucked is when they're trying to run. And when the good times are good, they're fucking printing money. Like, you're literally like, how does this dude have $40 million? But at the same time, it's like when things go sideways. And so I've seen one of the things that I definitely want to get to the place of is, if I do actually get into home construction, I'm not doing like 40 homes at once, right? Unless I have the business to do it, and it's its own separate business and it's not reliant on me, then that's a different story. But I originally want to start off with like 2 or 3 homes at once, like with a decent amount of leverage, nothing crazy. And I don't want to be in a place where I owe the bank like $2 million, right? If say they don't sell for some reason, or like I want to be in a place where I owe the bank $400,000 or $500,000 at its worst, and I could figure out a way to pay it off over time, and it's not going to be a big deal. But anyway, cool, man. You're the man.
Yeah, I think we'll end it here. I am not going to be around next week. I need to take a little bit of a break. Yeah. And basically I'm going to be in New York for some stuff I have to do for work, but we will connect after that.
Yeah. Let me know when you get back.
And yeah, definitely will.
Cool. Yep. You guys rock. Hopefully you guys enjoyed this one, and we will see you guys in the next couple weeks.
We didn't do the intro today. I know.
I'm sad. Are you sad? Do you want to do it as the outro?
Yeah, do it as the outro.
Talk to you guys soon. Thanks for joining. Make sure to hit the subscribe. Cheers.
Greed is good. the stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.